Hi everyone, welcome to this discussion on Kiddie tax. Kiddie tax is one of the more difficult concepts in income tax planning, and so I hope you find this video useful. Before we get into the details about how this Kiddie tax rule works, let's begin by thinking about why does the rule exist. The problem that this kiddie tax rule is trying to solve is that parents who are taxed at higher tax rates could shift their investment income to their children. And that's because children are typically taxed at lower tax rates. Without a kiddie tax rule, parents would just shift their investment income to their children, and that's how they might be paying less in taxes. So the solution is this kiddie tax rule. It taxes a child's unearned income above a threshold at the parent's tax rate. Now let's think about who it applies to. It applies to dependent children under 19 or under 24 if they are full-time students, and only if they have unearned income, that is investment income, interest income, or income from dividends. So the kiddie tax rule applies only to the unearned income of the children. Now here, I want you to internalize this image. The first thing we have is a threshold. And for the 2026 tax year, the threshold amount is $2,700. Then we have half of that amount, that is $1,350, and then we have a zero. Now, the first part between 0 and 1350, that part is tax-free to the child. Now the next half, that is between 1351 to the threshold amount, which is 2700, that is for the half of the threshold till the full threshold amount, that part is going to be taxed at the child's rate. So remember, first part, that is 0 to half the threshold, that's tax-free. And then half the threshold till the full threshold, that part gets taxed at the child's rate, which will be the lower rate. And then anything above that threshold is going to be taxed at the parent's rate. That's the kiddie tax rule. Now, what if child has earned income? That is, child has wages or salary, etc. Now, the earned income part always gets taxed at the child's rate because that's the child's earned income. Now, let's think about standard deduction for dependents. This is another area that's heavily tested. And standard deduction for dependents follows this rule. It's the greater of 1350 or earned income plus 450. Whichever is greater, we take that amount. But there is a cap. We cannot exceed the maximum standard deduction for a single tax filer. For the 2026 tax year, that's 16,100. This is a number that you don't have to memorize because this will be given to you during your CFP exam. You will have access to the tax table that shows standard deduction for different filing status. Now, what if a child has both earned income and unearned income? Now, that's one of the more complex situations. Now, let's look at an example to make sense of this complex situation. Ellie is 12 years old. This year, he earned $1,000 from tutoring neighbors and also received $4,500 in interest and dividends from his savings account. How much of his income is taxed at his parents' rate? Now, although the situation is rather complex because the child has both earned and unearned income, but the question itself is relatively straightforward to answer because it's asking about how much of his income is taxed at his parents' rate. Now, to answer this question, we need to figure out the unearned income, which is 4,500 in this case. And then we need to remember the image that we looked at earlier. We said that any unearned income above the threshold amount of 2,700 for the tax year 2026 is going to be taxed at the parent's rate. So all we have to do is figure out how much of the unearned income is above that threshold. That means we subtract the threshold amount 2,700 from the total unearned income here, which is 4,500, and that gives us 1,800. So that's the part that gets taxed at his parents' rate. Now, sometimes the question asks about the child's standard deduction. So let's figure out what will be Ellie's standard deduction. Again, to figure out the standard deduction, we need to figure out first the earned income, which is $1,000 in this case, and then we need to apply this formula. The formula says standard deduction for the child is going to be the greater of 1350 or earned income plus 450, whichever is greater. So in this case, our earned income is 1000, and this is the number that we are going to plug in here. So we have 1000 plus 450, that's 1450, and this 1450 is of course greater than 1350. That means the standard deduction for Ellie is going to be 1450. Now, another thing we should verify anytime we calculate this standard deduction is that whether the number that we just got, whether that's lower or higher than the maximum allowable standard deduction for single filers. And in this case, it's obviously smaller and we don't have to worry about this maximum limit. But under some circumstances, this might be relevant. For example, let's say, what if earned income in this case was 20,000? In that case, can we just add 450 to 20,000 to get a higher standard deduction? Well, no, because we need to work with this maximum possibility, which is 16,100. What that means is if Ellie's earned income was $20,000, in that case, his standard deduction would be $16,100. Now, let's say, what if the question asks how much of his income is taxed at his rate? Now, this is the hardest question that they could ask you from this concept. So now, to answer that question, we need to figure out the earned income, which is 1000, unearned income, which is 4500. We also need to figure out the standard deduction, and we have figured out all of that in the last two examples. And we are going to just apply what we have already calculated. So we have our earned income, unearned income, and our standard deduction. And that gives us the total taxable income, that is $4,050. Now, this is Ellie's overall taxable income. One part of it is getting taxed at his parents' rate, and the rest of it is going to get taxed at his rate. That is, the amount that gets taxed at the child's rate is equal to overall taxable income minus the amount that get taxed at parents' rate, and this is the part that we have already calculated. So our taxable income is $4,050, and the amount that gets taxed at the parents' rate, that's $1,800. So that gives us the amount $2,250, and this is the amount that's going to get taxed at Ellie's rate. So here is a summary that you need to remember. Let's think about three separate situations and what happens under each situation. What if the child only has earned income? In that case, the calculation is just like any normal person. We figure out their earned income, and from there we subtract their standard deduction, and that's the part that's going to get taxed at the child's rate. And then the amount that gets taxed at the parent's rate is just nothing, because the child has their own income, and that's why there is nothing that's going to be taxed at the parent's rate. That is, there is no Kiddie tax rule here. Now let's think about the second situation. That is, what if the child only has unearned income? Then what part gets taxed at the child's rate? Is the part that's above 1350 for tax year 2026, but not to exceed 2700. That's the threshold amount. So that's the part, the second half that we looked at in our image, that's the part that's going to get taxed at the child's rate. Now, how about the amount that gets taxed at the parent's rate? Well, it's any unearned income above the threshold amount. For 2026 tax year, that's 2700. So any unearned income above 2700 is going to get taxed at the parent's rate. Now, let's think about the toughest situation where the child has both earned and unearned income. In that case, first we figure out the amount that gets taxed at the child's rate, which is equal to taxable income, their overall taxable income, minus the amount that gets taxed at parents' rate. And taxable income is equal to earned plus unearned minus standard deduction. So this is something you have to memorize as well. And for the amount that gets taxed at parents' rate, This is just any unearned income above that threshold amount. That part is going to get taxed at the parent's rate. I should note here that kiddie tax is a really tough concept. And as a student, when I was learning this concept, I found it really hard to grasp and memorize. Preferably, you should print this table and have it in front of you so that you get exposed to this content over and over again. And as you get exposed to these over and over again and practice some of these kiddie tax problems, I'm sure you are going to improve and you are going to eventually internalize this concept. This brings me to the end of this video, and I'll see you in the next one.